G'day everyone, this is Jackson Millan, the Wealth Mentor.
It's Sam Panetta here.
And we are here for our weekly live Q&A, Ask Aureus Anything, where we discuss current events in wealth, finance and business. We answer your questions and we have a bit of banter on a Wednesday night.
We do. We're up to our 32nd episode, so we're starting to. This has become our regular lives now on a Wednesday night. We jump in here and we banter essentially.
It's evolved over the 32 episodes, hasn't it, Sam?
It has evolved over the 32 episodes. Before we were only answering just straight questions, and then we found a lot of the questions from a lot of our clients were really on the same topics about what was happening in the media at the moment. The media's got a lot of sway. So now we grab sort of popular trending articles and we talk about them. We put our 2 cents in, whatever that's worth, and we banter about that.
Yeah, so there's a lot of stuff going on. I think everyone wants to make sure they've got a finger on the pulse. So we want to give you the ability to read between the lines, work out what's BS and what's not, and hopefully make some informed and educated decisions.
Yeah, that's right. This is why we do the show, and it's why we built the Wealth Mentor community. So for anyone who's watching who is not a part or a member of the Wealth Mentor community, you should join up today. There's a couple of questions we'll let you in. There's about 1,100 members where we share value with each other, and it's just free content to educate you with all things money and wealth.
Beautiful. Now, before we get started, a bit of a general advice warning. So anything we talk about is general in nature. It's not tailored to your personal circumstances. So if you want to make sure that you have a tailored strategy or you want to act on any of the information you hear about in our Q&As, make sure you do seek professional advice.
All right, we'll get stuck into it.
Let's get stuck right in.
All right, so one of the articles we saw this week was NAB cuts executive bonuses amid charm offensive, reducing bonuses by up to 15% as a way of winning back consumer trust after historical scandals and poor consumer sentiment. Now, I feel that this has been happening since I was a kid. I remember back when I was 5 years old and the bankers back then were getting paid lots of money and everyone at the table had the shits, all blue-collared workers, they all had the shits that the executives were getting paid so much. And, 25 years later, it's still the same story and they're still doing these bits and bobs to sort of, not to stop the bank bashing. I don't think you're ever going to stop it. I don't know. What do you think? I think anyone who earns a lot of money, you're always going to get people that get the shits at them.
Yeah, look, I think you're right, Sam. I think, look, ultimately banks go through cycles of being, I guess, loved and praised by consumers or being completely hated. I remember it's similar to what you've said, Sam, like back when I was a kid. Do you remember St. George was like the kids' bank? They give you the little money box.
Yeah, because they had the dragon and everything.
And one of my first memories was around that. And then, of course, there was the Dolomites and all these things. So banks are always trying to pursue public relations strategies to win the hearts and minds of the people. Now, we've got 4 big banks in Australia, and they operate and make decisions in very tactical ways. Because, of course, they're competing against each other. They're trying to compete for market share. They're trying to make sure that they can essentially get to be the top dogs. And I think NAB, for a very long period of time, has always been the 4th big bank.
Yeah.
So I think that it's interesting to see how they're utilising the recent out-of-cycle rate increase as a way of them positioning themselves as a point of difference, coupled with cutting remuneration for executives, which, let's face it, most people get the shits when they think that there's some bloke out there, some old bloke, most probably a white bloke, sits in a boardroom and gets paid $13 million a year for doing not a whole lot. Look, and I get the shits of that. So if when you see that they're cutting the potential bonuses of these people, then I think that does win back some of the hearts and minds of the people. What do you reckon?
I'm going to play devil's advocate.
Yeah.
I'm going to play devil's advocate. The bankers get such big bonuses because they run such good businesses. The banks in Australia are hugely profitable. They've always been hugely profitable for very long periods of time. Now, if they were in any other industry and they were earning significant amounts of money and earning big bonuses, no one would get the shits. Like when mining was a big thing and they were earning huge amounts of money, no one cracked it because mining CEOs were on $10 or $20 million a year with big bonuses. Do you know what I mean? They earn a lot because they're very profitable business models, and it's one of these things. What do they call it? The tall poppy syndrome in Australia.
That's it. The tall poppy syndrome. And look, I think that ultimately, as long as the banks are doing the right thing by consumers, they're being fair. This always circles back to this whole Royal Commission that's going on at the moment. The banks have it's been uncovered that most of them have engaged in untrustworthy strategies and tactics that have taken advantage of their customers. And I think that more banks should be implementing penalties for their executives for not having a level of responsibility to their customers to make sure that it is fair and transparent. Now, I understand when you've got 50,000 employees, it can be very difficult to police a lot of the stuff that does go on, but it all comes down to culture. Culture in an organisation is really important. I've worked in a lot of the big banks, either as a consultant or as an employee, and I understand the culture that exists there. And it comes from the top. So I think it's one of those things. There needs to be harsher penalties for these executives. This is more of a sales strategy and a marketing strategy than a way of penalising the executives for doing the wrong thing.
It's fantastic PR. What's to stop them? They're cutting bonuses by 15%. What's to stop them from putting his base salary
exactly
up
right.
15%? They've done that. NAB, what they've done, right? So all the other banks were offering massive discounts over the past couple of months because they knew they were going to raise rates on everyone. Okay, so they're offering massive discounts, and then they raise the rates. And what NAB have been doing is not offering massive discounts. So essentially, they've only come into line with all the other banks after this has happened. But the perception is so good. So it's great marketing. It's great PR. I don't know, mate. I know that I've seen, obviously being a finance broker, I've seen myself and a lot of other people utilize the bank's money. So take out mortgages, buy properties with it, and create a lot of wealth from themselves.
100%.
Do you know what I mean? I've seen a lot of people get very, very rich at doing this very same thing. So instead of bashing the banks, why don't you buy some bank shares? Bank shares are very good. Or why don't you take out some finance and buy some properties, use their money and make yourself rich? Do you know what I mean? Instead of whinging about some faceless bloke at NAB getting a 15% cut on his bonus.
Exactly right. Now, thanks everyone who's joining. Thanks for jumping on. Paul, we've got Kim, Rog, Elise. If you've got any questions, if you want to kind of join in on the conversation, feel free to give us your 2 cents. We always value your opinion. I think, Paul, this one's going to be right up your alley, mate, this next topic. So Paul actually runs a business that he helps investors put solar panels onto their investment properties, and then basically leases that electricity created to the tenants to help investors create another income stream, which is really cool.
Excellent stuff. We're going to get Paul on the podcast.
We should get Paul on the podcast. I did call him the other day. He's in Bali. Hopefully you're enjoying your time in Bali, mate.
He's in Bali watching us.
Living the dream.
International superstars.
Exactly right. International movie stars. I love it. Now, next one. Australia's residential property market decreases by 13.3 billion. So, look, this is something that everyone's jumping on the bandwagon at the moment in terms of this property bubble. It's happened before, and it's basically, it always comes up. People have been talking about a property bubble in Sydney for the last 5 or 6 years, Sam?
Yeah, even before that, people were saying, property's too expensive in Sydney.
Yeah, so look, basically, this particular article, and they worked and they got data from a research house called SQM. SQM is really good on macro research. They look at vacancy, they look at essentially the social data and the demographics of areas. And it gives you, I guess, a piece of the puzzle when it comes to looking at the performance of property markets. So what they said is they basically said that Sydney and Melbourne have led the fall, and the slowdown is encouraged by a tightening of credit supply.
Yep.
Annually, property prices have fallen 3.9% in Sydney, the largest price fall since March quarter in 2009. Now, we've got to be mindful that Sydney property goes through cycles. Last growth phase was about 97 to about 03. And then the market sat flat from about 03 to 07. And then since 07, it's been very much moving upwards. So it's one of those things that this property market's been pretty consistent. It comes down to macroeconomics. There's supply and demand, and there's affordability. And with those two things being considered, property prices go up if everything's in line. Look, it's one of those things. Property is expensive. There's been lots of studies that have been done that probably the most unaffordable property markets in the whole world are in Australia and in Canada. The amount of household income that is the average household income compared to the price of the average property is substantial compared to most other places in the world. But from my perspective, that's an indicator of economic prosperity, right, Sam?
100%.
Like the property prices aren't just going to go up because people need to be able to afford the property prices to go up.
It's one of these things, right? So not all of Australia is expensive, right? It's really the only cities that are expensive.
Sydney and Melbourne.
Sydney and Melbourne. Yeah. Do you know what I mean? And Sydney is significantly more expensive than Melbourne. They're international cities. So they've got the growth in the population organically.
Yep.
They've got it from overseas immigration. And they're very rich cities. There is a lot of money in these cities, right?
Yep.
Some rich people here. And the average person is actually pretty wealthy as well. The average person in Sydney has actually got quite a significant amount of assets. So you look at any big international city, you look at Sydney, Melbourne, Tokyo, London, New York, those cities are significantly more expensive than 100%, Sydney.
Because they're desirable. People want to live there. Average household incomes are higher. It's all relative.
It's all relative. And if you look back over time, it's these international cities that are highly desirable, that are super expensive, that have continued to outperform all the other cities because that's where people want to live. That's where the opportunity is. It's here in Sydney. If you think growing up in Sydney or Melbourne or Tokyo or London or New York or any of these cities, your potential in life is only capped by your own ambition. If you want to be a multi-millionaire, there's nothing to stop you from doing it. Do you know what I mean? And I think that's what just keeps attracting more and more people here.
Yes, but I think people are getting too caught up in the micro of the short term.
Yeah.
If you're speculating in any growth asset, whether it be property, shares, small business, and expecting to make a big return on investment in the short term, you are only asking to lose money. So basically, if you're going to be buying property, you should be doing so when you can afford it. You want to make sure you're buying in an area where you're not going to be forced to sell. For example, if you've got a extremely high vacancy rates, like what we saw in far north Queensland, and people were banking on the oil and gas industry continuing to go and do great things. Once they constructed all the oil and gas refineries, the working force was reduced by sometimes 80 or 90%. And therefore, the property was no longer desirable. There was too much supply. Now you can't bloody rent the thing. We've had clients that have had properties that they bought up there that have basically sat on the market untenanted for 6 or 12 months. So that's one of the big forces, that if your property is going down in value, but you also can't rent it, it's extremely painful. So consider the demographics, consider the desirability, and consider it a long-term strategy.
You hit the nail on the head, mate. So when you start speculating in property and you buy in these regional areas and these out of the way areas that don't have that much fundamentals to go, forget about buying an investment property for 5 years. Why don't you think about the next 5 generations? And then that's where you should be buying property.
Exactly right.
When it does, like let's say you're buying somewhere in Sydney, over time you're going to do well. Like I know my property that I own in Sydney today, that one day maybe one of my grandkids is going to live in it. I know that property is going to be worth more one day than it is today. That means that if prices fall like they are now, is that a threat or is that an opportunity? It's an opportunity to accumulate very good assets at a cheaper price than what you could accumulate them 12 or 18 months ago. So people should be focusing less on this, and they should be focusing more on variables that they can control, which is their own cash flow, their own business, their own career. And then when they're at a point to accumulate property, they should be accumulating it. So I think the mindset's completely wrong. And it's because it's sexy and it sells newspapers to be able to, property's booming, shares are booming, or they're crashing. They're never just doing fine. Do you know what I mean? They're either booming or crashing according to the media.
Exactly
So
right.
it's one of these things. You've got to change the way you think about it.
Yeah, exactly right. So coming back to your point, Paul, definitely love to have you on the podcast, mate. Let us know when you come back from your trip. Now, question from Sally. We'll get to that. Just say good day to Paulo and Andrew Haig. Thanks for jumping on. Any questions you've got, feel free to post them. And Maurice, thanks for joining us, mate.
Maurice the king.
He's the king.
Maurice, you are the king. Give us another wave if you're still here, mate. Acknowledge our
All
king
right, so we've
statement.
got Sally's question. So guys, great to see your faces on a Wednesday. Question, with the silly and summary season upon us, any simple tips on how to handle budgeting when there's generally more social events and spending, for example, Christmas this time of year? Great question. So where we spend the majority of our time with our clients is around cash flow. Cash flow is the cornerstone of everything that you will be doing moving forwards. Without cash flow, without surplus, it is very, very hard for you to be able to build wealth and be able to achieve your goals. Now, my motto is you live for today and you plan for tomorrow. It's unfair to think that you're going to sit at home, watch Netflix, eat cornflakes for dinner. You want to live a life. So it's about having balance. So this is about having the right cash flow structure. So what I advocate you do, Sally, is first things first is do a personal profit and loss. This is a spreadsheet similar to what other people refer to as a budget, but
Dirty word.
Dirty word. But instead of budgeting, this is about us actually working out what our ideal life costs. So we should be thinking about things like Christmas, thinking about social events, birthdays, all of those types of things. Now, once we've been able to work that out, we then need to set up our bucket strategy in terms of our cash flow structure. We need to segment our fixed expenses or the necessities from our nice to haves, and also from our bills and holidays that are going to sneak up on us. And basically go through a process of putting money into our individual buckets so we can plan for these things in advance. Ultimately, what most people tend to do is run a single account where everything comes in and goes out from. It means they have no transparency. Or they're using a credit card where they're basically using the bank's money and then being forced to either try and pay it off before they incur interest or chip away at it over time as best they can. I've written a book all about this, Sally, and there's a structure in there that will help you. And further to that, I have some more content on the Wealth Mentor community. So if you want me to put you in touch with that, because we can go down the rabbit hole as far as you want. There's a lot of value there. It's all about planning. If you plan, then you will essentially have much more control over your spending as opposed to not planning and just allowing life to happen. So that's really the main thing. Make sure that you just account for everything that you're going to plan for.
Yeah, one of the things I'll add on the back of that, Sally, is Jackson's absolutely right. There, you've got your income and your expenses, and you need to plan ahead. Now, if you know that your expenses are going to be higher, I'm a massive advocate of, instead of trying to cut your costs to achieve your goals, to increase your means, so to try and earn more. So if you got Christmas coming up, if you got things coming up, I double down, I do more hours here in the office, I do more work, and I think other people should be doing very similar things, that they should be concentrating on how they can increase their income because life is going to continue to be expensive. So that's, you're not going to hear that from the financial industry. It's not going to tell you that, but that's the trick to it.
Well, Sally's on the right track. So Sally is a newly published author. She was on our podcast, actually went live this week. So for those of you who want to tune in, make sure you jump on and listen to what Sally has to say. She's got a great book. And Sally, with your thought leadership of helping people make the most of their lives, on Sam's point, speaking engagements, charging for coaching, doing all of these things are ways that you can increase your income to allow you to create more means for you to live the way you want, go on holidays, buy the gifts that you want for your loved ones, live life on your terms. So the key to it is the more income you earn doesn't mean the more you spend. You should try and control your spending, earn more income, and be saving more and make that money work for you. So hopefully some value there for you.
Sally Salvatore here from the office, he's just written that he is going to be sending you a copy of the personal profit and loss. I believe it's an Excel spreadsheet. You're going to be able to fill that out.
It's colourful. It's beautiful.
It's
fantastic.
It's very pretty, and that's a good start. So we'll flick it over to you shortly, I guess.
Yep. Hopefully you get some value from that.
Anyone else who's sitting there, make sure you throw some questions at us. We literally sit here to answer your questions, so do not be shy. All right, next article. The Australian dollar is holding near a 2.5-year low as global trade concerns take centre stage once again amid fears of a souring relationship between the United States and China. All right, so this has been going on for a little while, thanks to big Trump. He started this trade war, but what very few people that would affect. Like, honestly, if the Australian dollar falls, very few people would be actually affected by that.
Well, more so anybody who is importing products from overseas that are domiciled in US dollars. So particularly fashion industries and import-export businesses are going to be the most highly affected.
Yeah.
So I know that from previous experience when I was running my fashion business, given that I was getting majority of my goods manufactured in South Korea, and I was acquiring primarily in US dollars, a fall in the Australian dollar had a huge impact on me. But it also opened up the market for international buyers, particularly in the US, to buy from my store. So it's one of those things. It hurts you on the upfront in terms of your acquisition, but if then you're selling overseas, you're more competitive. And where this is a potential benefit, particularly given that we're a resources-based economy, the more the Australian dollar falls, it means that the value of our resources becomes more attainable for overseas buyers.
100%.
Our goods and services, travel to Australia, so tourism boosts. So you've got to give and get. And I think there's two sides to this.
Yeah, and I think prior to being a finance broker, I was a derivatives trader. I used to trade assets such as the Australian dollar. And the Australian dollar is what's known as a risk currency. So essentially, when people want to take more risk, the Australian dollar goes up, and when they want to take less risk, the Australian dollar goes down. Even though Australia is still pretty small economically on the global scale, we're a really small fish in a very large pond. And so, it does fluctuate a little bit. It fluctuated a lot during the GFC. If you ever look at a chart of the Australian dollar, it was doing really well, thanks to the back of the mining boom, and then it just collapsed off a cliff all of a sudden, within a very short period of time. So I don't know. What do you think about this, mate?
But look, I think it's just going to do its thing. Ultimately, currencies find the place in which they typically perform best, particularly Australian currency, given that we've got a pretty strong economy. It's well diversified. Fluctuation in Australian dollar is not going to be the be-all and end-all of our economy, and is not going to have a huge impact on GDP from my perspective. For economies that are hugely reliant on a particular import or export, big fluctuations in their currency can have tremendous impact. So look, once again, I think that we're pretty well weathered for the storm, if anything does happen. I think I'm more so concerned about, given our alliances with primarily the United States, although we've got a strong relationship with China, potential flow-on effects of these tariffs and the impact that it can have on trade, both for us exporting goods to China and importing goods from China. So that's, I guess, a bigger consideration for me. Further to that, one of the biggest impacts of all of these things is sentiment. Sentiment is typically what drives performance of most investment markets in the short term. It's people's perception of what they think is going to happen and what actually happens in reality. And the bigger the I guess the contrast of what people think are going to happen and what actually happens, the more severe the market reactions can be. So look, it's one of those things. Short term, long term, it'll work itself out.
Yeah, that'll be fine, mate. I'm not going to lose sleep over it. I tell you.
I'm not going to lose sleep over it myself, mate.
All right.
G'day, Elise. Thanks for joining us. If you've got any questions, feel free to shoot them at us.
Shoot them up before we start bantering about the next topic.
All right. Now, this is a flow-on. This is basically we had a question or an article about this last week in a similar style, and this has just continued to unfold off the back of the Royal Commission. So it was found as part of the Royal Commission that AMP has charged $1.3 million in life insurance premiums to more than 4,600 dead people through their superannuation. So AMP is Australia's largest fund manager. They're also Australia's largest authorizer, but they authorise the most financial advisors in Australia as well. So it's scary. And ultimately, that identified 4,645 superannuation members that were affected with these premiums that were being charged. it's just, it's ludicrous. There's two problems here. And once again, I've got a lot of experience behind the scenes with working with these big institutions. And the issue is that I don't think this was done maliciously, Sam.
No, I don't think so
It was an
either.
oversight. They don't have the technology or the infrastructure to be able to identify this. Now, the problem is actually deeper than this. AMP has one of the biggest, what's called orphan books of superannuation and insurance products in the country. What that basically means is that people have signed up or started working with an employer. They've probably been set up with an AMP superannuation fund. With that super fund, they've received an insurance policy. And essentially, they've forgotten about it. They've probably got 5 or 6 super funds floating around, so they don't even know. And it wasn't until recently where we have MyGov and things like that people have become a little bit more proactive in terms of managing their super. But in saying that, still, there's so many clients that we encounter that have multiple superannuation funds and done nothing about it. So what's basically happened is if someone has passed away, it is the role of their executor to try and chase down all of their assets and work out if there's any insurance, if there's any superannuation benefits that should be paid out, and essentially try and find all of that to pay out to beneficiaries. So what this shows me is that there's a lack of communication. Essentially, those people couldn't find these products and therefore find the insurance and basically cash them out or cancel them if they were not applicable. So it's a perfect storm. This just goes to show that AMP has so many customers and a lack of infrastructure to be able to actually keep in communication with these customers, they didn't even realise these 4,600 people had passed away, which is really, really scary. Look, it's sad.
Look, it's one of these things, right? It makes for a fantastic headline, but I truly believe that no one, unless you're a really bad person, would charge life insurance premiums to someone who's passed away.
Yeah.
And I don't know, how would they know?
Well,
how if they haven't spoken to that client in years, how would they know if that client had passed away or not?
So here's the thing, everyone. So let's assume that the policy, and in this case, you'd assume that the life insurance predates them passing away. I would doubt that somebody or AMP would go and set up these policies after they had passed away. So what would basically happen is that they've now discovered all of these people have passed away. Most of these policies might be between $200,000 and $500,000 that they're insured for. So it's basically going and getting in touch with those people's families and letting them know that they're potentially entitled to receive a couple $100,000 additional money to their estate. Further to that, most of these insurance providers will backdate the premiums that were charged until the date that they passed away. So in addition, they're going to get a big refund of all of that. I would expect, this has only recently come up in the Royal Commission, but if that were me, if my old man passed away last year, if AMP called me and basically said, hey, look, your old man had this policy and we're going to pay you a couple $100,000, he's already gone, you'd kind of be, oh, wow, that's a good surprise.
I'll take the money.
You take the money. You're not going to be happy about it, but it could change a lot of people's lives. So once again, media hype, fear mongering, putting a spin on it. It's good that the Royal Commission has happened because this may have gone unfound if it wasn't for their investigations.
And they'll build better systems and processes 100%. To stop this stuff now. So it's improving the financial system.
Correct. Exactly right. So one of those things, interesting to know. And I think this further raises, there should be a royal inquiry into financial services on a more regular basis.
Yeah, correct. All right, for everyone who's watching, make sure that you ask your questions.
Yeah, do you have more than one super fund floating around? And have you even gone onto your MyGov account to see how many super funds you got? Let us know.
Out of the people that are watching, tell us how many of you know where your superannuation is, how many funds you have. Someone say something.
Someone say something.
Say something. Come on.
All right.
Come on. All right. So next is politics. I hate talking about politics. All right. It says Donald Trump's strict tariffs upset China, which has promised to make America pay. I don't understand these tariffs, right? I don't understand it. So essentially, the more work that goes around, the better it is for everyone. So everyone should be encouraging everyone else to do more work. Now, when you start imposing restrictions on people to do less work, the net result is bad for everyone. on a grand scale. It might be good for some people, a small majority, but for the large majority of people, it's bad. So I don't know. I don't know much about global politics, but I know that there should be encouraging more. And the one thing I will say about this is that they're going against structural change, right? So the world is globalizing. So they're not going to stop it from globalizing. They might put a speed hump in the road, but this is a structural change about the way the world operates economically. So it's one of these things. It's going to be a blip on the radar. This isn't going to exist in 20 years, I'll tell you.
Yeah, look, I think this is a battle of strength. Two of the biggest superpowers in the world that are really trying to battle it out for top position. And ultimately, China relies a lot on export. They are a manufacturing economy primarily, and synonymous with the production of most things these days. And the US has basically is a big manufacturer and does export a lot as well. So ultimately, this is about trying to inflict pain as a way of I guess, a feat of strength, a display of strength. And neither wants to essentially not show face in I guess, when coming up against the other. So they're in a bit of a stalemate. I ultimately think that this will probably be imposed, will be in place for a short period of time, and then be dissolved through a mutual agreement that it was probably pretty silly in the first place. At a local level, is this going to have a tremendous impact? I guess this comes back to the previous point in terms of the Aussie dollar discussion that we're having, Sam. This may have an impact on things like currency, on potentially commodity prices, potentially flow-on effect to other things by way of consumer sentiment. But it's one of those things. These types of standoffs have happened before.
They don't make any sense. You imagine two bricklayers at a job site, and bricklayer 1 says to bricklayer 2, pass me that brick. And bricklayer 2 says, no, I'm not going to, you grab your own brick. And then bricklayer 2 says to bricklayer 1, lay this brick for me. And bricklayer 1 says, I'm not going to lay it. So now these two idiots have to go and walk and grab their own brick and lay their own brick. The job's going to take twice as long because they're not working together. I should run for Prime Minister, I tell you.
You're just going to talk about bricks.
All right.
No, Sam for Prez. I love that. Good on you, mate. That was a really good analogy. I really liked that.
See, Leanne liked it. Look at that. Leanne loved it.
It's all about the bricks. The brick metaphor. That's fantastic.
I'm a simple man.
Good on you, mate.
All right.
We're going to get back to stuff that's probably a little bit more interesting.
I like this one.
This
one's interesting. This one's interesting.
Rents are dropping across Sydney because more rental properties are sitting vacant than any time in the past 13 years. So once again, this is data that's come from SQM, and basically it's revealed that there's 19,000 rental properties in Harbour City that don't have a tenant. So current vacancy rates in the city are around 2.8%. Now, once again, this is fear-mongering. We work very closely with property analysts and economists who do get a lot of data in this space. Now, generally speaking, a balanced market has around about a 3% vacancy rate. So of all properties that are available in a market, 3% of them at any point in time being on the market is fair and reasonable. Now, if it is any higher than that, it is indicative of potentially one of two things or both things. One, there is too much supply of property, so then we need to get an understanding of the supply pipeline of developments coming onto the market, flooding the market with a substantial amount of stock at any one time, or that rents are potentially too high. The market is correcting, particularly due to supply and essentially, or a lack of demand, and essentially the market has to reduce its expectations in terms of rental. Now, what we've seen, any of you who have gone to pretty much any capital city over the past 2-3 years, what is the only thing that you see in the sky? Cranes, right? There is a ridiculous amount of development going on, particularly high-rise development or in the burbs, medium density unit developments. And because of this, there is a substantial amount of property hitting the market. We're seeing it in DY now, right?
Yeah, correct, 100%. There's, it's not the population's been increasing significantly over time. But as Jackson's mentioned, there's been a lot of property that's come onto the market into that time, and there's still more to come.
Yeah.
But let's put this into perspective. So Jackson said an equal market is at about 3% vacancy rate. So it means that all being equal, rents aren't going to rise or fall. Anything above 3%, you see rents starting to fall. Anything below 3%, you see rents continue to increase. Now, the vacancy rate now, even after this increase, is 2.8%. So it's still below an equal market. So you're still going to see properties in some areas increase in rent. Now, taking a whole look at Sydney's misleading, because there's some suburbs that haven't had any development in the past 20 years because they're fully landlocked and you can't develop them. And the vacancy rates in those types of suburbs are close to zero. Yeah. They're close to zero. And you've got other suburbs that are full of high rises, or that are brand new suburbs out west, and the vacancy rates are going to be significantly higher.
4, 5, 6, sometimes 7%.
That's right. And that's a dangerous level of vacancy rate. Yeah. And it's one of those things. I think when you're investing in property, you should really be looking at vacancy rates that are falling and that are already below 3%, because that means you're buying in a pretty strong market that is tightening up. And what does that mean? It means you're going to get some rental growth and you're going to get some capital growth as well over time.
Yeah, and look, ultimately these vacancy rates are increasing because we're seeing these developments come online. They've been in construction for 2-3 years sometimes, and they're all kind of hitting the market now or over the next 12 months. So we're definitely going to see rental yields soften in some areas where there is a lot of development. Yeah. But we're going to get to a point where the market will sit flat, like it did between 03 and 07, and it's going to get to a point where rents will continue to increase in value whilst the market sits flat, and then the cycle will go again. Is that going to take 5 years, 7 years, 10 years? Who knows? But eventually it's going to work itself out. So you should just be really mindful that if you are looking to buy an investment property, go onto these providers like SQM. They do suburb reports. Do your research. Or if you really want to do it seriously, invest in the services of a professional buyer's agent or property analyst, somebody that will engage you on a fee-for-service basis, somebody that knows the territory, they understand what they're doing, they can help you minimize the risks.
That's one of those things. That's a whole nother topic. People winging it when they're investing.
100%.
You know, I've seen so many people go out there and buy shares because they read one article in a magazine, and that's it. That's the end of their research, because Punter McPuntface told them to buy it, or people that go and they just buy, properties because someone's told them that they should.
The next suburb it's going to go.
The suburb's going to boom. It's a boom. So it's not a boom suburb. If it was a boom suburb, they wouldn't have to come and bring their properties to you in a presentation somewhere. The suburb would be fully stocked and there wouldn't be nothing for sale. So it's one of these things. If you're going to invest, take it seriously. Yeah. Take it seriously, because there's a lot of money at stake. And I say to Jackson all the time that it's almost that people are hardwired to lose money when they're investing because of the same consistent mistakes that people have been making for 100 years, and they still continue to make it today, where there's information out there. You don't have to make the same old mistakes when you're investing.
Yeah, look, it's sad. I think there's 3 issues here. There is too much information available. People are overwhelmed by the choice. Everyone has an opinion. And the thing about the media and economists and all these people, they have to take a firm position on something. They can't say, I'm indifferent. They have to take a firm position, because that's what sells papers, that's what gets their opinion across the line. And whenever their forecast ultimately comes true, they said, told you.
They get it wrong 9 times out of 10, and on the 10th one they go,
60% of the time it works every time. So ultimately, you just need to make sure that you get educated. So the issue is that there's too much information. The second one is people don't have a plan. You need to have an objective framework that holds you accountable to making the right decisions. And the last one is people just don't have the time. They just want to invest a small amount of time to compensate for all the lack of time they've invested in the overall plan in the first place. So if you don't if you don't get the right information, you don't have the right plan, you don't invest the time, it's going to be very hard to get it right.
100%. Yeah. What are your guys' thoughts on investing? What do you guys think about that?
Yeah, what do you think is going to happen in property markets? Be very interested to hear your views and what your perspective is or forecast on the future. You think property prices are going to sit flat? They're going to go down? They're going to go up?
They're probably going to do all three, mate, at some stage
At the
in
same
the future.
time, simultaneously, Sam. It's going to do something that we've never seen before. It's going to do a backflip.
Oh,
All right. So
All right.
we've got some questions here, Sam.
Yeah, so we had a few come through during the week for this week's session. We had Julian Vanderwall has asked us, what is your outlook on financial markets leading up to the end of 2018 and into 2019? I don't really have a strong opinion either way. I think that if you were looking into the property markets, it would be about selecting markets geographically that are still performing, not that are tipped to perform, but markets that are actually performing right now, and the chances are that they'll be continuing to perform. We've seen weakness in Sydney and in a couple of other capitals and a couple of other satellite cities to Sydney, and I think we're going to continue to see that for a little while yet to come. So that's sort of my take on property. On financial markets, share markets, equity markets, it's one of these things that I genuinely have no idea. I don't think anyone knows what's really going to happen. But my take on it is more about having a plan. So let's say property share markets do well. I will continue to consistently invest in the share market every single month. Right, into the end of 2018 and into the end of 2019, because I know in 10 years' time, 20 years' time, I know the share markets are going to do well. And let's say that something bad did happen and share markets fell, then that would be a fantastic opportunity for me to double or triple down on my monthly investments. So assuming that I was taking care of my own backyard and that my household budget was healthy, I had a surplus income every month, that the business was performing well, and these are factors that are under my control, then I would continue to have money to invest in the market every month, and I would, as I said, double or triple my investment in a share market in a time of chaos if things were doing bad, and then in 10 years' time or 20 years' time, I'm going to make even more money. So I don't really have any particular punt on financial and property markets. I think you should accumulate as much quality assets as you can without going broke, and that's the real key to it.
Yeah, so look, I think there's a few things to be mindful of. Through history, share markets have had a negative year, 1 in every 4 historically. And we've seen that since the global financial crisis, there's been very few substantial drops. There's been a couple of very small kind of flash
10 up years in a row or
Correct.
something.
Yeah, there's been a few flash crashes, but have typically recovered. And say, for example, the US market has pretty much hit month-on-month record highs. And what that results in is that price to earnings ratios or PE ratios are very, very high, which is an indicator of investor sentiment. People are confident. People are willing to pay substantial multiples above what a company is producing in its earnings as a reflection of its share price. And that basically means that people feel that the market is going to continue to go. Now, I do believe that over the next year or two, there is going to be some type of correction or a recession because over time, historically, it has always happened. But as Sam said, that presents an opportunity. Now, there's an example that was done in Tony Robbins' latest book, Unshakable. And they basically modeled the investment in the share market of 3 different people. There was someone who was extremely lucky, and they invested $2,000 every year, starting from 1993 for 20 years. And they were able to time the market perfectly and get it at the exact bottom of the market every single year when they invested their $2,000. The second person was really unlucky. They had their $2,000 and they invested their money at the exact high point of the market every single year, just before the market fell. And then there was the third person who sat on their money in cash. They put their $2,000 into the bank account and just waited. Now, person number 1 ended up with about $86,000 at the end of the period of 20 years. Person number 2 ended up with about $75,000. So although they got their timing really bad every single year, they still ended up substantially higher, not that far off the best person. And the person who put all of their money in cash ended up with about 36,000. So with all of these scenarios, what's the best thing to do? Just get your money into the market. Continue to invest, allow money to work its magic, allow compounding to work, sit it there for the long term. If the market falls, continue to stick the course. It is the people who retreat to cash and that sit on the fence are the ones that ultimately lose out.
Yeah, it's one of those things. You have to stick at it for the long term, though. That's the key. Do you know what I mean? Because if you invest and you invest and you invest, and then the market goes down and you shit yourself and you pull all the money out, then you're only going to lose money. So you need to take a good hard look at your own character to see if you're willing to accept that kind of volatility.
All right, so the next question. Now, this is a question from one of our clients, Ed. So do you think there's going to be a debt crisis coming, and what would be the implications here in Australia? Now, we spoke about a little bit about this last week. So there's big issues that are occurring in Central America, South America. Turkey has big issues at the moment in terms of their current debt and their ability to service that debt. And as a result of that, interest rates at a government level are increasing exponentially. Inflation is getting out of control. There's a lot of systemic issues coming out from this. Now, this seems to be an emerging markets problem right now. And ultimately, most emerging markets get their money in terms of lending from the developed world. So if the emerging markets default, that can create financial pressure on the developed markets, and most developed countries, US particularly, is carrying a substantial amount of debt right now. Now, if there was some type of debt crisis, meaning that there's mass default across the world, ultimately that could have a flow-on effect to property markets. We could potentially see, if it was bad enough, similar to what happened in the US with Lehman Brothers, substantial big banks collapsing. Now, if that was to occur, look, the banks have implemented safety measures. They have gone through, after the global financial crisis, to implement responsible lending. Lending is getting tighter, asking more questions. It's taking longer. It's starting to slow down. It's one of the reasons why the property market is softening.
I think it's the only reason property market is softening, because demand for property is still through the roof. Yeah. It's just people can't borrow what they used to be able to borrow.
So I think that we're very well sheltered. But let's play devil's advocate here. Let's assume that the market blows up. Everything goes to shit. The big banks in Australia collapse. The property market is destroyed and left in ruins. We're going to have bigger problems.
I'm going to move to the farm.
Move to the farm. So yeah, look, we're going bush. Look, I think it's one of those things that there is a possibility that it will happen. Is it a probability? No. The banks have too much to lose to allow this to happen. So would you prefer to just kind of make the best of it and then just allow it all to blow up, or implement strategies that are going to ensure that the situation can be diffused? We escaped the global financial crisis pretty much unscathed, right, Sam?
Yeah, very, very small implications for Australia.
And 2007 was really the kickoff of the last property growth of the market, keeping in mind that the global economy was stuffed. Now, how affordability got back to about 25% of the average Australian household on their minimum mortgage repayment, which means they had a lot of capacity to push up the market. Now, the average affordability is stretched. I think the average household spending about 42% of their household income on the minimum mortgage. So if rates continue to go up and things spiral out of control, people are going to be in pain. But it's just a matter of, I guess, is that going to happen? Who knows?
It's one of these things, mate, right? So the powers that be don't want this sort of stuff to happen. And you saw it in America. If everyone was left to their own devices, then nearly all the banks would have gone under, right? But the government and everything, that the Reserve Bank and everyone that controls what's going on in the economy, they don't want this to happen. It's not in their best interest. So you have to think that over the long term, and when these crises happen, you have a lot of things in your favour to keep the wheels turning and keep the ship running. You need to think, if there was a massive recession in Australia, interest rates wouldn't go up. They'd go down. You'd see the Reserve Bank cutting interest rates to zero if they have to negative if they had to, like they did in Europe 10 years ago or so. So that means that, and then they look at, do you remember when Rodney was giving all that money away and all of that? You got
stimulus packages.
Stimulus packages.
The US did quantitative easing, and there's lots of different monetary policy.
Literally printing money in America and just like giving it away to institutions to lend out to stimulate the economy. Now you need to think that money is a man-made thing. You know what I mean? And it's essentially controlled by the reserve banks of all the countries. So it's not that there's not more money out there. They'll just make more. They don't even have to print it these days. They just need to punch some
couple of
ones and zeros into a computer, and voila, there's more money that's being created. So it's one of these things that the global financial crisis was probably the worst thing we'll ever see in our lives. That was
it's once in a lifetime.
A once in a lifetime thing. The last time something like that happened was in the 1930s. So unless I live to 2130, I'm not going to see it. I'm probably not going to live that long. But the thing is, it was horrific for a lot of people, especially in Europe and the United States. But it was relatively short-lived. What did it last for? Maximum of 18 months?
A couple of years. So the worst year ever in terms of share markets was the Great Depression. And I believe that in 1931, markets fell by, I think, 42% in terms of sustaining for an entire 12 months. And followed by that in 1933, markets came back 51%. So it just goes to show, if you can stick your guns and see it through and not be forced to fire sell, then there can be substantial gains to be had, and you have the ability to ride the wave if these things do come up. The whole idea of crisis is there's two sides to it. There is the fear, but there's also opportunity. So you just it's a matter of perspective.
Everyone I know today is wealthier than what they were 10 years ago.
Yeah.
Do you know what I mean? Or even 15 years ago, before the crisis.
Yeah.
And most people, especially the risk takers, those who are more comfortable with taking risks, actually done better off the back of the.
Look at Warren Buffett.
GFC.
His net worth halved in the global financial crisis.
Yeah, no one else lost $40 billion. It was the only person on earth who actually lost $40 billion and then made it all back, plus double sum over the next 10 years.
Exactly right.
And he just didn't do anything. He just sat there eating Maccas for breakfast and just made back his 40 billion plus another 40 on top. So learn from the masters, learn from the guys that understand how money functions.
All right. So let's cover off one more, Sam.
One more, then we'll wrap it up.
We'll wrap it up.
All right. So this is a question I got today from a client who called me up, said, I want to buy my first home, but I don't know where to start. What should I do? The first thing that someone should do when you're buying your first home is get a pre-approval from a bank, because at that point, you will understand exactly how much you can afford to spend on a property. There is no point in offering $600,000 for a property if you can only afford to buy at $500,000. So in order to get a pre-approval in place, you should talk to your bank or your mortgage broker, or talk to me, and you essentially take a look at what your borrowing capacity is. So based on how much you earn and based on how much your expenses are, how much the bank is willing to lend you, what your deposit is, how much you can contribute, or whether there's a family guarantee or something like that. You combine the two, and then once they're combined, you work out what your maximum purchase price is. You select a lender that's going to do a good deal, you submit it to the bank, you get your pre-approval in place, and then at that point, you've got the golden ticket, and that is when you can start shopping for a property. But not before then. It makes me nervous when people go out and buy properties without a pre-approval. I've seen a lot of people lose $200,000, $300,000, $400,000 from doing that. Significant amounts of money because they were overconfident that the banks would lend it to them. Banking is not what it was 20 years ago. So you have to be very careful, and you need to make sure that you're approved before you go out there and have a lash at a property.
100%. And look, even if you haven't saved the deposit yet, it's worthwhile going through this exercise. You might not get a pre-approval, but a good broker or lending specialist should be able to tell you, okay, well, if this is the property you want to buy, this is what your borrowing capacity is today, this is how much you're going to have to save to get your foot on the ladder. So once you've got that, there's your plan. Then you just got to work at saving it. So that's the big thing.
100%. Yeah.
All right, everyone. So thanks for joining us. We hope you got lots of value. Feel free, if you're watching this, once we go offline, if you've got any topics or questions for us that you'd like us to cover, we'll make sure we do that next week. We will see you same place, same time next Wednesday.
See you then.
Catch you later.
Thanks.